All right, let's dive right in and unlock one of the absolute core concepts in the ICT methodology, liquidity. Seriously, if you've ever watched the market spike against you for what seems like no reason at all, this one idea, well, it might just change the way you see the charts forever.
It's that question that drives every trader crazy at some point. Why did the price suddenly whip around right after you got in? Or why did it just blast through a level you were sure was going to hold? The answer, you'll find, almost always comes back to one single thing.
And that thing is liquidity. Put simply, liquidity is just pools of orders sitting in the market. We're talking stop losses, buy stops, sell stops, the works. You got to think of it as the hidden fuel that smart money or the big institutions absolutely need to get their huge orders filled. See, price isn't just moving randomly. It's being drawn to these zones of liquidity like a magnet. So here's what we're going to tackle. First, we'll establish why liquidity is literally the market's fuel. Then we're going to break down the two main types you need to know, internal and external. From there, we'll pinpoint the specific targets, BSL and SSL. And finally, we'll look at the two big ways price deals with these levels, the sneaky sweep and the powerful run. Okay, first up, liquidity as the market's fuel. Getting this is so important because it shifts your whole perspective. You stopped just seeing candles on a chart and you start seeing the reason why those candles are moving in the first place.
All right, now for the core framework. In the world of ICT, not all liquidity is created equal. You have to break it down into two main types, internal and external. And trust me, understanding this difference is absolutely critical to following the market story.
First, we've got external liquidity, or ERL. This is the big one. This is the main destination. It's sitting outside the current trading range. We're talking about those obvious old swing highs and swing lows. That's where all the stop losses and breakout orders are clustered, making it the #1 objective for the big players. And then you have internal liquidity, or IRL. This is all the liquidity inside the current price range. Think of things like fair value gaps, those little imbalances price leaves behind. So if external liquidity is the final destination, internal liquidity is kind of like the series of gas stations on the highway. Price will pull in to refuel before continuing its main journey. This table really nails the difference. Just look at the outcome. External liquidity is where you see the huge impulsive moves, those major trend continuations or boog reversals. Internal liquidity, that's about the smaller moves, the little pullbacks. It's the market taking a quick pit stop before it makes its next big push toward that external target. And this is the golden rule, the one thing you really need to remember. Price moves from internal to external. It will pull back into a fair value gap to take internal liquidity. That's it gathering fuel, and once it's gassed up, it launches towards its real objective, the external liquidity at an old high or low. That is the fundamental rhythm of how price gets delivered. Okay, so we get the types of liquidity, but where exactly do we find these targets on our charts? How do we pinpoint them? Well, that's where buy-side and sell-side liquidity come into play. Let's kick things off with buy-side liquidity, or BSL. This is that big pool of orders sitting just above any significant high, and you have to see it for what it is, a major trap for traders who don't know what's going on. So where does this stuff hang out? Well, BSL always collects above old swing highs, or even better, above equal highs. And it's made of two things. One, the stop losses from everyone who is short, and two, the buy-stop orders from all the breakout traders who are just waiting to jump in on a move higher. And here's where it gets really counterintuitive. Conventional trading wisdom tells you to buy a breakout, right? But with ICT, it's the total opposite. When price pushes above an old high, you don't even think about buying. You get ready to sell. Why? Because that so-called breakout is usually just a quick raid on BSL before price slams back down. Now let's flip it over and look at the mirror image sell-side liquidity, or SSL. And yeah, you probably guessed it. This is the giant pool of orders that sits just below any significant low. SL is always found below old swing lows or those clean equal lows. It's made up of the stop losses from everyone who is long, plus all the sell stop orders from traders trying to short a breakdown. It is the perfect inverse of BSL. And again, the logic is completely flipped on its head. When you see price break below an old low, your gut reaction is probably to sell, to join the move down. But that move is often just a hunt for sell-side liquidity. So the rule is, don't sell the breakdown. Instead, get ready to buy the reversal that is likely to follow. So let's tie this all together. When price goes hunting above highs, it's grabbing BSL to stop out the shorts, which often starts a big move down. When it hunts below lows, it's going after SSL to stop out the longs, often before a major rally. Seeing the market through this lens is a total game changer.
All right, so we know where the liquidity is. Now we get to the fun part, the action. How is this liquidity actually taken from the market? Well, this brings us to the most common type of market manipulation, the liquidity sweep.
A liquidity sweep, you might hear it called a stop hunt or a liquidity grab, is a quick, sharp, and totally manipulative move. Price will intentionally poke just above a high or just below a low, just far enough to trigger all those stops and pending orders, and then boom, it violently reverses, leaving all the breakout traders trapped on the wrong side.
The mechanics of it are brutally simple. Step 1, price gets drawn towards that liquidity pool. Step 2, it pierces right through it, grabbing all the orders. And step 3, an immediate sharp reversal kicks off, leaving a whole lot of people wondering what just happened. It's a classic move.
But here's a question. What happens when price takes out a liquidity level and just keeps on going? What if it doesn't reverse? Well, that's not a sweep. That is something totally different, and it's called a liquidity run. It's all about trend continuation. A liquidity run is basically the opposite of a sweep. When price hits a liquidity level, it doesn't just tap it and back off. No, it slices right through it with real force and continues aggressively in that same direction. A run is a sign of true strength and tells you the trend is still very much alive. Okay, let's put them side by side to make it crystal clear. A sweep results in a reversal. A run results in continuation. A sweep looks like a sharp rejection at the level. A run looks like a powerful explosion through the level. One is for manipulation, for trapping traders. The other is for continuing the trend. Being able to tell these two apart is a crucial skill. So, next time you pull up a chart, I want you to ask yourself this. Are you just looking at the price, or can you actually see the liquidity? Can you see those pools of orders that are acting as fuel, pulling and pushing the market? Because once you can see that, you're no longer just reacting. You're starting to anticipate.